Welcome to this insightful journey into the world of exchange-traded funds, specifically those offering monthly dividends. As we embark on this financial expedition, we'll be exploring the fascinating and often lucrative realm of ETFs, shining a spotlight on those funds that have the added advantage of providing investors with a steady stream of income each month. Now, you may be wondering, what exactly is an exchange-traded fund? Simply put, an ETF is a type of investment fund and exchange-traded product traded on stock exchanges, much like individual stocks. They offer a way for investors to buy and sell a basket of assets without having to buy all the components individually. But why are we focusing on those ETFs that offer monthly dividends? Well, monthly dividends can provide a consistent income stream, which can be particularly beneficial for those seeking regular returns, such as retirees. Moreover, they allow for quicker reinvestment, thereby potentially accelerating the magic of compounding. In this enlightening video, we'll be delving into 4 specific ETFs that have caught the eye of investors worldwide. These are PGX, JNK, GOVT, and SRLN. These ETFs have been chosen due to their track record of providing consistent monthly dividends, along with their overall performance in the market. PGX, or the Invesco Preferred ETF, is known for its focus on preferred securities in the US. JNK, the Spider Bloomberg Barclays High Yield Bond ETF, is recognized for its exposure to U.S. high-yield corporate bonds. GOVT, the iShares U.S. Treasury Bond ETF, gives investors exposure to U.S. Treasury bonds, while SRLN, the Spider Blackstone GSO Senior Loan ETF, is noted for its investments in senior loans, offering a unique risk and reward profile. Each of these ETFs has its own unique attributes, making them worthy of consideration for investors looking for a monthly dividend income. Stay with us as we dive into each of these ETFs and their unique attributes. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. First on our list is PowerShares Preferred Portfolio, also known as PGX. Now you might be wondering, what is PGX and why is it noteworthy? Well, buckle up, as we're about to take a deep dive into this intriguing fund. PGX is an exchange-traded fund, or ETF, that focuses mainly on preferred stock. Preferred stock, for those who may not know, sits somewhere between common stock and bonds in the hierarchy of corporate structure. Preferred stockholders have a higher claim on dividends and assets than common stockholders, making it an attractive option for those seeking a steady income stream. The PowerShares Preferred Portfolio, PGX, houses a vast array of these preferred stocks, providing a unique focus that sets it apart from many other ETFs in the market. This focus allows PGX to offer a higher dividend yield, which is music to the ears of income-focused investors. But what makes PGX a good buy now? Let's delve into its performance and dividend yield. Over the past few years, PGX has consistently outperformed many of its peers, demonstrating a remarkable level of stability in an otherwise volatile market. This is largely due to its focus on preferred stocks, which tend to be less susceptible to market fluctuations than common stocks. In addition to its steady performance, PGX also boasts a strong dividend yield. Dividend yield is essentially the ratio of a company's annual dividend to its share price. The higher the dividend yield, the more bang you get for your buck, so to speak. As of this recording, PGX has a dividend yield of around 5.5%. That's right, 5.5%. To put that into perspective, the average dividend yield of the S&P 500 is just under 2%. That means PGX's yield is over twice the average, making it a particularly attractive option for those seeking regular income from their investments. However, like any investment, PGX is not without its risks. The fund is heavily weighted towards financials and utilities, sectors that can be vulnerable to interest rate fluctuations. Therefore, it is crucial to consider your own risk tolerance and investment goals before diving in. But let's not lose sight of the forest for the trees. PGX's unique focus on preferred stocks, its consistent performance, and its impressive dividend yield make it a compelling option for any investor seeking monthly income. Not to mention, its relatively low expense ratio makes it an affordable choice too. In conclusion, PGX, with its unique focus and consistent performance, is a strong contender for your investment. It offers a blend of stability and income that is hard to find in today's market. So, If you're seeking a reliable income stream and are willing to take on a bit of sector-specific risk, PGX might just be the portfolio enhancer you've been searching for. Next, we delve into the Spider Barclays High Yield Bond ETF, popularly known as JNK. This intriguing financial instrument is a high-yield corporate bond ETF that tracks the performance of U.S. dollar-denominated, high-yield and non-investment grade corporate bonds in the market. Let's break that down. When we say high yield, we're referring to bonds that offer higher interest rates because they have a lower credit rating. In other words, they're riskier than your average bond. However, with greater risk comes the potential for greater reward. And that's where the appeal of JNK lies. Investing in JNK is a bit like being a venture capitalist. You're investing in companies that might not have the best credit rating but have the potential for significant growth. And remember, growth for them means returns for you. This makes JNK a fascinating option for those willing to take on a bit more risk for the potential of higher returns. Now, why is JNK a good buy right now? There are a few reasons. First, it offers a high yield. In a world where interest rates are at historic lows, finding yield can be like finding a needle in a haystack. But JNK, with its focus on high-yield bonds, offers an attractive yield that's hard to find elsewhere. Second, JNK has the potential for capital appreciation. Remember, these are companies that are poised for growth. If they succeed, the value of their bonds goes up, and so does the value of your investment. Third, JNK provides a level of diversification. While it focuses on high-yield bonds, it's not tied to any one industry or sector. This means that if one sector struggles, your investment won't necessarily take a hit. That's the beauty of diversification. It helps to spread risk. Fourth, JNK is accessible. As an ETF or exchange-traded fund, it can be bought and sold just like a stock. This means you can get in when you want and get out when you want. It's flexibility at its finest. Finally, JNK has a history of performance. While past performance is no guarantee of future results, it's always comforting to know that a fund has a track record of success. So, to sum it up, JNK offers high yield, potential for capital appreciation, diversification, accessibility, and a history of performance. It's like a Swiss Army knife of investing tools. It has something for everyone. But remember, investing always comes with risk. So do your homework, consult with a financial advisor if necessary, and make sure that any investment aligns with your personal financial goals and risk tolerance. JNK offers an opportunity to benefit from both income and growth, a rare combination in the ETF space. Moving on, let's explore the iShares U.S. Treasury Bond ETF, abbreviated as GOVT. In the world of exchange-traded funds, or ETFs, GOVT holds a unique position. It's a fund that focuses on U.S. Treasury bonds. But what does that really mean? Well, when you invest in GOVT, you're essentially lending money to the U.S. government, and in return, you receive regular interest payments. This is the crux of what makes GOVT such an appealing choice for many investors. Now, one of the key features of GOVT is its broad exposure to U.S. government bonds. It includes treasuries of various maturities, from 1 month up to 30 years. This diversified approach helps to spread the risk, making GOVT a less volatile investment option compared to those funds that focus on a single maturity segment. But what's so great about U.S. government bonds? Well, they are considered among the safest investments in the world. The risk of the U.S. government defaulting on its debt is extremely low, making these bonds a reliable source of steady income. That's why U.S. Treasury bonds, and by extension GOVT, are often referred to as risk-free investments. Of course, like any investment, it's not entirely devoid of risk, but the risks are minimal compared to other investment options. Moreover, GOVT's monthly dividend payment is another attractive feature. It's a steady stream of income that can be particularly appealing to those looking for a reliable income, such as retirees or those nearing retirement. So, why is GOVT a good buy now? Well, in times of economic uncertainty, investors tend to flock to safe haven assets, and U.S. government bonds are seen as just that. They offer a sense of security not found in more volatile markets. Investing in GOVT allows you to tap into this safety net, providing a cushion against market volatility. Furthermore, with interest rates at historic lows, bond prices have been on the rise. This means that not only does GOVT provide a steady income through its dividends, but there's also the potential for capital appreciation. However, it's important to note that while GOVT offers stability and reliable income, its yield is relatively low compared to other ETFs. This is the trade-off for the safety it provides. Therefore, GOVT may not be the best choice for those seeking high returns. Instead, it's more suited to conservative investors who value stability over high growth. In conclusion, GOVT offers broad exposure to U.S. government bonds, providing a safe and steady income. It's a less volatile investment option that can serve as a solid foundation in any portfolio. Even in turbulent times, GOVT stands as a beacon of stability in the stormy seas of the investment world. If you're looking for a safe and steady income, GOVT could be an excellent addition to your portfolio. Finally, we turn our attention to the Spider Blackstone GSO Senior Loan ETF, known as SRLN. For those of you who may be unfamiliar, SRLN is a fund that primarily invests in senior loans, giving it a distinctive edge in the ETF market. Now, you might be asking, what's so special about senior loans? Well, that's a great question. Senior loans are essentially loans given to businesses or corporations, but with a twist. They are given priority over other types of debt. This means that in the event of bankruptcy, the lenders of these senior loans are the first ones to be paid back. This priority status is what makes senior loans, and by extension SRLN, so appealing to investors. So why should you consider adding SRLN to your investment portfolio? Well, there are a few key reasons. Firstly, SRLN's emphasis on senior loans means that it has a lower risk compared to other types of debt. Remember, these loans have priority status, so the risk of not getting your money back is considerably lower. This makes SRLN a safe bet for those who are more risk-averse but still want a piece of the action in the debt market. Secondly, SRLN's focus on senior loans gives it the potential for high income. These loans typically have higher interest rates compared to other types of debt, meaning that they can generate a substantial income. This makes SRLN an attractive option for income seekers, who can benefit from the regular payments that these loans provide. Finally, SRLN's exposure to senior loans means it has low interest rate risk. As most of you know, when interest rates rise, the prices of bonds and similar securities tend to fall. However, senior loans are usually structured with floating interest rates, meaning they adjust with market rates. This makes SRLN less sensitive to changes in interest rates, providing a safeguard against potential losses. But what makes SRLN a good buy now? Well, in the current economic climate, with low interest rates and high market volatility, having an investment that can provide a steady income and low risk is more valuable than ever. And that's precisely what SRLN offers. It's also worth noting that SRLN has a monthly dividend payout, making it a regular income source for investors. Moreover, its track record of steady performance, even in turbulent market conditions, further strengthens its case as a worthy investment. In conclusion, SRLN, with its unique focus on senior loans, is an investment opportunity that's hard to ignore. It offers a blend of safety, income potential, and resilience against interest rate fluctuations. This makes it an attractive choice for a wide range of investors, from those seeking a steady income source to those looking for a safer bet in the debt market. SRLN, with its unique focus on senior loans, offers a compelling opportunity for income seekers. We've explored 4 exceptional ETFs today, each with its unique features and benefits. PGX, with its focus on preferred stocks, offers a higher yield than most other investment options. JNK, while being a high-yield bond fund, provides a level of risk mitigation due to its diversified holdings. GOVT, on the other hand, is a government bond ETF that offers stability and predictability, critical elements for any portfolio. Lastly, SRLN is a senior loan ETF and can be a great hedge against rising interest rates. In the dynamic world of investing, diversification is key. A balanced portfolio with a mix of these ETFs can help you weather market fluctuations and optimize returns. It's not about putting all your eggs in one basket, but rather spreading them across baskets with different characteristics. Remember to subscribe, like, and share this video if you found it helpful. Stay tuned for more insightful investment tips. Until next time, happy investing.